Imagine waking up one day to find your investments have increased tenfold. This is not a dream. For Ramdeo Agarwal, often referred to as India's Warren Buffett, this is the result of his disciplined investment strategy, deep research vision, and unwavering belief in the power of compound interest. Over a career spanning nearly 4 decades, he has journeyed from a small village to the pinnacle of India's financial world. Let's delve into the principles of his investment strategy that can serve as a guide for every investor. Agarwal's investment philosophy. The QGLP framework. At the heart of Ramdeo Agarwal's success is the QGLP framework, which is based on 4 key pillars: quality, growth, longevity, and price. This strategy helps him invest in various sectors from aviation to pharmaceuticals. Quality, the foundation of sustainable returns. For Agarwal, quality is not just about profitability, but also about the integrity of management and business strength. He invests in companies whose leadership is beyond doubt and maintains transparency. Indigo, Interglobe Aviation, is a prime example, controlling 38% of the Indian aviation market. Despite the volatility of the aviation sector, he invested in Indigo because it is a company with an asset-light model, low debt, and stable cash flow. Quality also means not just investing in a company based on its reputation, but ensuring its growth is sustained. He cautions investors to avoid issues like excessive debt and opaque financial statements. Growth. The engine of compound interest. Agarwal's portfolio includes rapidly growing sectors. He holds 8 infrastructure companies, 9 steel companies, 7 IT companies, and 5 pharma stocks. But for him, growth is not just limited to immediate revenue growth. It is based on continuous expansion. For instance, he has invested in the steel sector. Even though it faces global challenges, he believes that India's infrastructure demand will make it profitable in the long term. Longevity. The approach of long-term investments. While many investors chase quick profits, Agarwal invests in businesses that can last for a long time. His buy right, sit tight strategy reflects this idea. For example, he held Hero MotoCorp shares for years, even when their value remained stable. Eventually, due to its strong foundation, the company became a leader in the two-wheeler market. Additionally, he is adept at identifying future sectors. Recently, he has invested in quick commerce companies, which, given the changing consumer behavior in urban India, can provide long-term opportunities. Price. The margin of safety in investment. Even the best companies can prove to be bad investments if bought at a high price. Agarwal's rule is simple. Always buy at a price lower than the intrinsic value. During the 2024 market downturn, he said, "If a stock comes to your ideal price, start buying even if the rest of the world is scared." This discipline saved him from significant losses during the 2008 recession. Portfolio construction. Balancing diversity and conviction. Agarwal's portfolio is an excellent example of strategic diversification. He invests in various industries but maintains a strong position in each sector. This structure allows him to balance stability, such as steel, infrastructure, and high growth, IT, pharma. Lessons from mistakes. The cost of overcautiousness. Like every veteran investor, Agarwal has made mistakes. He regrets staying out of the market from 2003 to 2014. When the Indian market saw historic highs, he admits, staying out of the market is the biggest mistake. His experience shows that staying invested in the market is better than waiting for the right time. Suggestions for common investors. 1. Start early and maintain a long-term perspective. His first investment in 1987, 500 rupees, has turned into crores today. He says, understanding compound interest requires not talent but just patience. 2. Do not follow the crowd. When other investors were chasing tech companies in the 2000s, Agarwal invested in the auto ancillary sector. Today, those companies are a significant part of his portfolio. 3. Avoid debt. He warns, investing with debt is the most dangerous mistake. In a falling market, investors have to sell their stocks to repay loans, leading to significant losses. 4. Keep learning. He reads 15 to 20 books every year and believes that knowledge, like wealth, grows with compound interest. 5. Consider taxes, but don't make wrong decisions. In the 1990s, he did not sell a falling stock just to save taxes, which cost him crores. Now he focuses more on fundamentals than saving taxes. Future strategy. Where are the opportunities in 2025? Despite global uncertainties, Agarwal believes that India's economic growth can yield returns of up to 25% annually. Key sectors for the coming years. Quick commerce. A blend of technology and logistics. considering the growing demand in urban India, green energy, innovation in solar energy, and the electric vehicle sector. Pharma 2.0, biotech companies discovering new drugs with the help of AI. Conclusion. Will you adopt this investment strategy? Ramdeo Agarwal's story proves that investing is not a game of luck but a result of discipline, research, and patience. His QGLP strategy can be a guide for every investor. As he says, the best time to plant a tree was 20 years ago. The second best time? Today. So, will you adopt this investment strategy?